thank you guys so much for tuning into today's live stream. Today is March 17th, 2025. And to begin today's live stream, let's take a look at the economic calendar here. So today we have core retail sales and retail sales here at 6:30 Eastern time. That is some volatile news, so just watch out for that. And yeah, so today's objective here on the daily time frame is, so based on this daily candle here on Friday, it's an up close candle, and the easiest thing for me to assume here is that we're most likely going to take out previous day high, right? Based on the way that we close here on this daily candle, it's bullish, it's an up close candle. Easiest assumption is for us to take out previous day high. So once we complete this objective, right, so we end up taking out previous day high here coming into the morning. After we take out previous day high, I no longer have a objective here on the daily time frame. So for right now, I'm actually going to elect to use the intraday candles, such as the 4-hour time frame. So the 4-hour time frame here, the 6-hour time frame, the 8-hour the 8-hour time frame, or the 10-hour time frame. So all of those time frames here during the intraday basis has an objective, right? Because every single candle has an objective. So depending on how we close here on the 4-hour candle this morning and the 8-hour candle will give me an morning objective, right? So we close on the 4-hour candle and the 8-hour candle in about 25 minutes or so. So depending on how we close on that 4-hour candle and the 8-hour candle, I will then proceed to treat that bias, right? But like I said, previous day high was the draw of liquidity for the daily time frame. The weekly time frame, at least, I actually don't want to see us take out previous week's high. So this weekly fair value gap here, I don't want to see prices retrace into it. And if we retrace into it, that means us taking out previous week's high. And I don't want to see us do that. I don't want to see us retrace back into this inefficiency here on the weekly time frame. I do, however, want to see us take out previous week's low, or we could possibly consolidate here on the weekly time frame. So that's just something that you do want to look out for. So yeah, I mean, coming to this week, consolidation or previous week's low. Don't want to see us trade up into previous week's high. Daily objective was previous day high, and after we complete the daily objective, I can't use it anymore. I would like to use the intraday time frames to trade. But yeah, that's basically all I do have for today, right? I do want to just wait until the 4-hour candle closes and the 8-hour candle closure for a morning objective. And so let's just backtrack here just a little bit. Right, so previous day high is the draw of liquidity, right? That's what I want to see us take out, simply because of the way that we closed here on the daily candle. So let's take a look at the 4-hour time frame and the 6-hour time frame. So on the 6-hour time frame, there is this 6-hour fair value gap, and on the 10-hour time frame, there's that 10-hour fair value gap, right? If the daily candle suggests for us to take out the daily high, we should respect this inefficiency here on the 6-hour candle, or on the 6-hour time frame and the 10-hour time frame. Both of those two fair value gaps are suggesting higher prices, which is in confluence with the already existing draw of liquidity, which is previous day high. So this bearish fair value gap here on the hourly time frame, I'll denote that by a red one. So this bearish fair value gap should not be respected, right? This fair value gap should be inverted, and it should be used as a stepping stone towards the previous day high draw of liquidity if we're going to be trading in alignment with that, right? So that's just something that I do want to point out as well. So that's how you kind of determine if a fair value gap is useful or not. And it all depends on what is your narrative, right? In my narrative coming into today, like I said, this candle here on the daily time frame, based off of on Friday, it's suggesting higher prices. It's bullish. I want to see us take out previous day high. That's the easiest assumption for me to make, right? And two fair value gaps that suggests the idea, that supports the idea of higher prices, is the 6-hour fair value gap and the 10-hour fair value gap. We trade into the inefficiency, we respect it, we take out previous day high. Also, here on the 2-day time frame, we're also rebalancing this inefficiency here. Just something that you do want to note. This daily candle, or this 2 daily candle is suggesting higher prices as well. And yeah, I'm just going to wait and just kind of see how we close here on the 4-hour candle and the 8-hour candle. It seems as if we did take out previous day high here on NQ, or not NQ but ES here as well. Very very good. So yeah, NQs, or not NQs but ES's daily candle here as well, suggested higher prices. Very easy assumption to make here for the case of higher prices. We traded to the 6-hour inefficiency here on ES. We respect it, and then we continue higher. Same thing here on the 10-hour time frame as well. Yep, we trade into the 10-hour inefficiency. We take it out, or we trade into the inefficiency, and then we take out previous day high. So here I would actually like to say that if we break past this swing low here, this would be considered a market structure shift, right? So let's just denote that. So if we trade past this low here, market structure shift, that would be considered a market structure shift. So let's keep that in mind. That is a market structure shift, and let's just put that here. Market structure shift. Oh yeah, cảm ơn má. Dạ, bye má. Bye má. Let's see if we can retrace back into the premium of this dealing range here. 4-hour dealing range. See if we can do that. I'm gonna be right back. I gotta go get a bowl of noodles real quick. But yeah, hopefully I was able to explain to you guys how I kind of view the markets there. Very simple approach, right? But it works. so yeah, I'm just gonna be patient. Just practice that patience and wait until we close here on the 4-hour candle and the 8-hour candle. Practice patience. No need for me to really force anything here as of right now. But yeah, this rally here, very interesting, right? We had a massive sell-off though, to be honest. So from this swing high, we sold 3,000 points, 3,200 points here on NQ, which is kind of insane, right? That's a lot of price movement. So here today we could actually retrace back into like the discount or the premium of this dealing range or something like that. Who knows? But as of right now, I'm looking towards the premium of this specific 4-hour dealing range here. So if we can trade back into this like orange box or red box, I would per se, I would like to see that. But let's see. So if we can make a bullish closure here on the 4-hour candle, and we haven't retraced, and if we haven't retraced yet back into this premium of this dealing range in 14 minutes, I would consider taking a long into premium. So it depends on how we close here. While you guys watch me eat, let's watch this.
Before I understood.
Let's watch this video here.
Before I could use my mind to move a submarine,
Explain to us what's
I had to
happening
be
here
born
in the
for it.
economy.
America is currently in a bit of an interest rate standoff between the Federal Reserve and Donald Trump, and it's a problem that stands to wreak havoc not only with the wider economy, but also with everyday Americans. Have a look at this chart. This is the federal funds rate, or the US interest rate, over the past few years. As we can see, interest rates were at zero. They then climbed to levels not seen in decades as America battled their painful post-COVID inflation, but recent trends have seen interest rates cooling down. inflation did cool. Jerome Powell said enough's enough, and the federal funds rate was dropped a full percentage point over 3 separate rate cuts. But with Donald Trump now implementing trade policies that are generally inflationary, what happens next is a question many economists are now asking, and it's a question that is being understandably avoided by the president. So is America about to see another inflation wave like what crippled Americans during the 1970s? Could the next move for interest rates actually be up? Interest rates are a tricky concept to understand completely, but the main thing to understand is that they determine how expensive it is to borrow money. Whether you're a homeowner paying down a mortgage or a business looking to build a new store, or the US government itself, higher interest rates make your interest payments higher, and lower interest rates make your interest expense lower. Now, it's the Federal Reserve that sets interest rates in America, more specifically the Federal Open Market Committee, a group of 12 people led by a man named Jerome Powell. These are the people that meet every month or two to discuss whether they're going to raise, lower, or hold interest rates. Now, importantly, the Federal Reserve is independent of the US government, and their dual mandate is to keep prices in the economy stable while also keeping employment as high as possible. What this means is that if inflation is ramping up, they will raise interest rates, which puts the brakes on the economy, it cools it down. And if inflation comes down, but the economy needs to be stimulated and employment needs improving, they will lower interest rates. But it is an important thing to understand. The Federal Reserve and the US government are separate, but they're also interdependent. Now, this relationship usually sees them working together. For example, when COVID hit, the US government passed massive stimulus bills to send out stimulus checks, increase unemployment benefits, and to offer businesses support. At the same time, the Fed responded by slashing interest rates to near zero to make borrowing cheaper. It launched quantitative easing, buying the government's bonds to stabilize financial markets. This lowered borrowing costs and supported the economic recovery. So the government needed to help its citizens, and the Fed helped make government borrowing cheaper by lowering interest rates. Now, that's a great example of when the government and the Federal Reserve worked together, and everyone got what they wanted at the time. But why you're seeing the media cover recent beef between Jerome Powell and Donald Trump is because the Federal Reserve and the US government aren't as aligned anymore, and this goes back to inflation. So the Federal Reserve has a long-term target of 2% inflation annually. As we know, what happened after the government and Federal Reserve teamed up during COVID is that inflation started to soar, up to a peak of 9.1% in June of 2022. And this meant that the Federal Reserve had to step in and raise interest rates to try and restore price stability, one of their two main goals. Now, this worked, and it did knock inflation back down to 2 to 3%, and it has led to 3 interest rate cuts, reducing the interest rate from around 5.5% to 4.5%. The problem we've seen recently is that inflation hasn't continued on that downward trend back to 2%. In fact, it started to pick back up a little. And this has led Jerome Powell to essentially say the FOMC is no longer considering further rate cuts at the current time.
We do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation.
So interest rates are staying put for the time being against people's wishes for lower rates, but that also makes sense. The one thing the Federal Reserve doesn't want to do is lower interest rates too far too soon and spur on another inflation wave, where Americans suffer and all of a sudden the Fed has to raise rates again just to get things back under control. This actually happened 3 times during the 1970s, and what it ultimately led to was inflation spiking up violently to 15%, and the Federal Reserve needing to raise interest rates to 20% just to get things back under control. That's pretty painful. So the Federal Reserve is hell-bent on ensuring America does not see a second inflation wave. But then we get to the really interesting thing that's happening today, Donald Trump's trade policies. Now, I have made videos on this already, but as we know, the one thing Donald Trump has focused on so far in his second term is import tariffs. We're seeing it with Canada, Mexico, China. We're seeing it with steel and aluminium. There's talk of reciprocal tariffs elsewhere. There's a lot going on. But one of the main problems with tariffs is that they are generally inflationary.
Everybody's forecasting some inflation effect from tariffs. It'll hit the exporters, the importers, the retailers, and to some extent the consumers.
For example, with tariffs in place, when Walmart orders their avocados from, say, Mexico, they'll have to pay the US government an additional tax, normally a percentage of the total order value. So if there's a 25% tariff on goods from Mexico and Walmart's total cost rise to $1.25 per avocado as opposed to $1, This means that they need to raise prices on the end buyer of the avocado, which is the American citizen. So Americans end up paying more for lots of goods that are on the shelves. Hang on, that's inflation. That's not what the Federal Reserve wants at all. So we've got this interesting situation now where, sure, the government might push for tariffs, but the Federal Reserve might also have to raise interest rates on Americans if inflation starts to rise. This is Jerome Powell talking about the tariffs just a week ago.
The path to sustainably returning inflation to our target has been bumpy, and we expect that to continue. The new administration is in the process of implementing significant policy.
Alexa, turn off my bedroom light.
Distinct areas: trade, immigration, fiscal policy, and regulation.
Alexa, turn off my bedroom light.
Of these policy
Thank you.
changes that
Okay.
matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their likely effects remains high. We do not need to be in a hurry, and we are well positioned to wait for greater clarity.
And for those that haven't heard Jerome Powell speak before, when he says the Federal Reserve does not need to act right now, what he's effectively saying is that they're going to keep interest rates high for the moment to wait and see what happens next. And if inflation were to rise, he has previously stated that they won't hesitate to hike interest rates. But this hasn't made Trump particularly happy, and the reason for this is because moves that the Federal Reserve make to control monetary policy have real financial effects on Americans. If the Federal Reserve were to raise interest rates, everyone feels that added financial squeeze, but as we know, when everyday people feel the negative changes in their own financial position, the first thing they point the finger at is the government, which would likely reduce Donald Trump's popularity. It would make the economic consequences of his America First trade policy very real for Americans, and it probably wouldn't feel that good. So that's point number one. And then on top of that, another reason why this annoys Trump is that higher interest rates would also start to slowly increase America's interest payments. When the government's debts roll over and are refinanced, that would happen at a higher interest rate, which kind of cancels out the effect of bringing in more tax revenue through tariffs. So it's these reasons why you see Donald Trump now trying to exert pressure on the Federal Reserve to go against their mandate and in fact lower interest rates.
I'll demand that interest rates drop immediately, and likewise they should be dropping all over the world.
That's quite different to what we were hearing from Jerome Powell. So the short of it is we're now in this very interesting scenario where the Federal Reserve and the US government aren't aligned anymore. Donald Trump wants sweeping tariffs that will raise prices on everyday Americans and stimulate inflation. And hey, at the same time, he wants interest rates to be lowered because that's popular. But the Federal Reserve is still quite worried about inflation and is A, keeping interest rates high for the time being, is also B, sitting prepared to raise interest rates if government policy does cause the inflation rate to rise. And to be honest, this is precisely why the Federal Reserve's independence from the US government is so crucial. It provides a necessary check against short-term politically motivated decisions that may be popular but could ultimately harm Americans' long-term financial stability. Here's what Jerome Powell had to say on the matter.
In central banking, nobody wants to be working in a central bank when inflation is really high. But everybody who works in a central bank knows what they have to do when inflation is high. But when you have very high inflation and you have to do this, this is why we're independent. It's not for the good times. It's for the times when we're doing something which may be unpopular. That is our assignment.
It's a tricky assignment because eventually you unfairly become the enemy. So hope that makes sense as to why at the current time there's a bit of a standoff happening between the Federal Reserve and Donald Trump as each want to go down different paths. But what happens next? What are the potential outcomes we could see from here? Well, I think there's really 3 points to talk about. The economic risks of this standoff, Trump's potential response and political ramifications, and finally what the global implications might be. So when it comes to the economic risks, we've kind of touched on this already. If the Federal Reserve holds firm and keeps interest rates as they are, that's probably the right thing to do, but of course borrowing will remain expensive. That means higher mortgage rates, more expensive credit cards, and tougher conditions for businesses trying to expand. In terms of the stock market, which had been pricing in lower rates, usually the market will struggle under the weight of prolonged tightening, although honestly, who the hell knows in this current environment? But perhaps most importantly in this argument, the US government itself will have to start refinancing little chunks of debt coming due at these elevated interest rates, which is piling on even more costs at a time where deficits are already ballooning. So that's how it's looking at the current time. Now let's say inflation actually does pick up because of these tariffs. Now if that happens, the Fed might have no choice but to raise rates again. And this is where things get even more concerning, because if history is any guide, another round of rate hikes could very well tip the US economy into recession. We've seen this happen before. As I was talking about with Paul Volcker raising interest rates to 20% in the 1980s, it was a painful time, albeit necessary. You know, businesses pulled back, unemployment rose, and borrowing ground to a halt. The only way to deal with that inflation was to go big and crush it once and for all, which really, really sucked for Americans. So the question becomes, is that where we're heading again? Because make no mistake, if the Federal Reserve has to do a series of rate hikes once more, you know, there will be consequences. Companies will slow hiring or even start laying off workers. Small businesses already struggling under high interest payments may start closing their doors. And consumers who have already been relying on credit cards and loans to get by in a high cost environment would get squeezed even harder. This is why Jerome Powell and the Fed are so hesitant. They know how fragile this situation could become. They know that one wrong move now could really hurt the US economy. So that's the economic side of the equation. Then we also have Trump's potential response and the political ramifications.
All right, so we're about to open here. So yeah, based on how we close here on this 4-hour candle, very easy or not.
Ideas
I don't want to use the word
are meant
easy,
to live.
but I could assume that we're most likely going to take out the 4-hour high and the 8-hour high, right? Simply based on how we close here on the 4-hour candle and the 8-hour candle. So for right now, like I said, I'm bullish simply because of how we closed here on the 4-hour candle and this 8-hour candle. But let's take a look at the lower time frames, shall we? So the hourly time frame isn't necessarily supporting the idea of higher prices, right? It's kind of wonky. So I'm actually just going to wait and see how we close here on maybe another 15-minute candle or so, and see how we close here. But as of right now, the hourly candle isn't really suggesting higher prices just yet. But yeah, like I said, 8-hour candle and the 4-hour candle right here suggesting higher prices. I want to see us take out the 4-hour high coming into the morning session here. And yeah, so that's kind of my bias coming into this morning. I want to see higher prices. I want to see us take out the 4-hour high. And yeah, with that, I'm going to go into some of the pros and cons here for this week and see what I can continue to do and what I could improve on. But yeah, hopefully you guys had a wonderful weekend so far. I was able to go to Colorado this week with my friends. And yeah, I mean, here's some of the pictures. I have more, but yeah, like these pictures are really nice. The scenery there, amazing. It did snow the last day that we were there during the morning. So this was kind of awesome to see as well. But yeah, back to the pros and cons here. So what should I continue to do to come into this week, right? Taking consistent models. Every single trade that I take, I should be able to identify what my higher time frame objective is going to be. How am I going to align myself with that higher time frame objective, right? Which is my model. And after knowing where my model is, I would then have to find a entry pattern, a fair value gap that supports the idea of whatever my model is suggesting. it's been a while since I've been in front of the charts, so taking this week as kind of a refresher, as kind of a week to rebuild all of the habits, all of the I guess the habits that I need to be a I guess a good trader. Is this is the week to kind of rebuild those habits, right? Second, being patient this week, being extra patient. Because it's been a while since I've been in front of the charts, I don't know where I'm at emotionally yet. It's am I more inclined to press a button, or am I more inclined to just sit on the sidelines? I'm not too sure. So just being extra patient and just kind of filling myself out here for this first week back is going to allow me to really see where I'm at. So be patient. Allow the markets to come to you. You don't want to force anything. You don't want to force a trade onto the markets. Third, like I said, allowing this week to be a rebound week. Slowly and effectively get back to the normal routine, and working towards that consistency again, right? What are some things that I can work on? So, like I said, don't force trades to happen. In general, you shouldn't you don't force anything to happen. You do the things that are necessary for you to succeed, but you can't force things to happen. And second thing, just journal every single day. What did I learn that day, right? So if I learned something new, like yesterday, what did I? So I was preparing for a interview this upcoming Wednesday, and there's this method called the STAR method, where you are breaking down a story to a interviewer. So essentially, you break down the story by the situation, the task, the action, and the result. So that's the STAR method. That's something new that I learned from yesterday. Some improvements here for next week is consistent trades. Like I said, being able to identify a higher time frame objective, a model, and a entry pattern is required when taking a trade, right? If anybody were to come up to me and ask me, hey man, why'd you take this trade here, I can explain to them clearly and effectively. Second, being patient. Allow yourself to regroup, align with your daily routines, and don't force trades to happen. If the market conditions aren't favorable for your strategy, then don't force anything. Third, if you learn something new a day, then journal that, right? Knowledge is something that you cannot be taken away from you, and journaling what you have learned is only going to help you, it's only going to benefit you from retaining that knowledge. So let's go back to the charts here. So yeah, looks like we're trading back into this inefficiency again. We never disrespected this inefficiency just yet. So depending on how we close here on this 15-minute candle will suggest to me if we're going to take out this 4-hour high, or who knows, this 30-minute low. As of right now, I'm not going to force anything. And just allowing myself to be a little bit more patient towards the markets is something that is, like I said, is going to be something I need to practice coming into this week. 5 minutes left until the 15-minute closure. Left until we close here. And if we don't really, if this 15-minute candle doesn't close bullish, then I'm actually just going to just end the stream here. And I'm sure that we'll probably see us take out 4-hour high, but I don't want to stay on. I don't want to stay on the stream for too long. And wait for that. So I'm just gonna just wait. If nothing really happens, then nothing really happens. It's very simple. Well, let's take a look at ES here actually. ES traded into this inefficiency, creating this bullish closure. Give me a second. I'm actually gonna log into my funded futures account. So give me 1 second. Alright, so let's see. Couple minutes left until we close. Are we going to retrace back into this inefficiency is the question. 1 minute left. Probably not gonna give us a opportunity here, to be honest. I don't think we're gonna have a fair value gap to enter off of. So ES looks like we're most likely going to take out the 4-hour high. And let's see where NQ does. What NQ does here. So ES is extremely close to the 4-hour high. This is the 4-hour high, by the way, on ES. That black line. Okay, so 20 seconds left. Two, one. So here I do want to see us take out the 15-minute high on NQ, and we're most likely going to take out the 15-minute high here, and the 4-hour high here as well on ES. So let's see. Yeah, bullish 15-minute candle that aligns itself with the 30-minute order flow slash 4-hour order flow. So notice how the 30-minute high is the same high as the 4-hour high. That suggests is that we're most likely going to complete the 4-hour objective within the next 30 minutes. And here on the 15-minute time frame, there's a little bit more information. There's this 15-minute fair value gap. Prices trades into the 15-minute fair value gap, respects it, and then we create a bullish 15-minute candle. So on ES, I do want to see us take out the 15-minute high here. After we take out the 15-minute high, we should expand higher towards the 30-minute high. That's kind of what I do have for ES. Hey, what day's today? Huh? She went to work already. And you didn't say bye to her. Hmm? Alright guys, it does seem like it's about 45 minutes now past, or 45 minutes of streaming. Thank you guys so much for watching, and until next time.